Welcome back, traders. It's Carlo from Blueberry, straight off the trading floor. Oil prices have opened a lot higher this morning. We reached $111 a barrel, currently trading $107 a barrel, but it was classic risk off last week. And that's how we begun this morning, Monday, the 9th of March, where oil prices have shot higher. The US dollars is gaining some safe haven demand as well too, again, across the board. Equities have been hit. Equities were soft last week and they're soft this morning. So continuing is the Iran conflict. We've also got the oil price spike, and we've also got growing recessionary fears. You may have remembered that last week I spoke about how markets were repricing rate cuts by the Fed this week, perhaps delaying them or perhaps removing them completely with this latest oil price shock. I have the US West Texas crude daily chart in front of me. I just wanted to show you how oil prices have jumped and gapped higher this morning. But let's get back to this chart. Let's just quickly go through the week ahead, what might be important for traders going forward in terms of economic data releases, and then we'll go back to the current state of the market, which is very much risk off. In terms of economic data releases this week, traders might wish to focus on Chinese inflation data today. Tomorrow, NAB and Westpac business consumer confidence in Australia, balance of trade in Germany. But Wednesday we have US CPI. Now we already know that CPI is a little bit higher in the States, and with the recent surge in oil prices, I think traders may look through this latest CPI data and just focus on what is happening right now in terms of conflict. Later in the week, for those of you trading sterling and the FTSE 100, we have GDP in the UK, and followed by the end of the week, US Michigan consumer sentiment. We'll see if that is adversely affected by what is happening globally. Let's get back to oil. Oil prices moving, as you can see on the chart here. It's now down to or below 160 US a barrel from $111 about an hour ago. So quite volatile this morning. Importantly, you can see how we broke 2 weeks ago. We broke the upside above 67 US a barrel, and we haven't looked back. So oil prices have continued to shoot a lot higher on very strong momentum. The stochastics oscillator is above the 80 level, suggesting that this recent uptrend in prices may continue in the short term. Where to from here for traders? Well, will history repeat itself? And by that I mean, back in 2022 when Russia invaded the Ukraine, oil prices shot up to 120 US a barrel. We also saw the S&P 500 hit hard, down 20% for the year. We go back to 2008 when the oil price spiked up to 147 US dollar a barrel and S&P 500 fell 37%. Are we in for those kind of moves over the short to medium term for 2026? So these are some of the things for traders to keep an eye out in terms of long-term targets. Right here, we've already reached 111 US dollar barrel this morning. So your next target on the upside for those of you who are keen to be long oil at these levels is 120 US a barrel, and then 147 US a barrel as well. On the downside, if we do get any kind of positive developments out of the Middle East, we could see this gap filled back down to around 90, 91 US a barrel. But at the moment, the technicals look very strong. You can see here in yellow, the 20-day EMA is above and diverging away from the slow moving 50-day EMA in dark blue. As I mentioned before, stochastics above 80, all suggesting positive or further upside momentum for oil prices in the near future. Next, I'd like to draw your attention to US equities. I have the Dow Jones 30 daily chart in front of me. And what we've seen recently is that surprise, very weak US non-farm payrolls data on Friday, minus 92,000 jobs in the States, together with higher oil prices leading to higher inflation, is not a good recipe for equities in general. If we take a look at the daily chart here, you can see here how prices have fallen quite rapidly over the last few weeks. In fact, since we made a high of above 50,000 early February, prices are now down 8.2% so far. And this is on strong downward momentum. So if you use one of the momentum indicators such as RSI or stochastics, I have the stochastics down below. You can see stochastics here drop sharply to below this 20 level. So technically and fundamentally, it suggests that there may be possibly further downside in US equities. We take the Dow Jones here and you're a trader looking to go short the Dow, looking for further downside targets. I would suggest this previous swing low point of around 45,700 is a possible target. If we do break that, then down to 45,200. For those of you who are looking for a retracement, I would say that first of all, we need to fill in this gap, and the high of this previous candle, around 48,150, should present strong resistance, whilst momentum is very strong on the downside. It's not only US equities. Look at the DAX 40 in front of me here on the dailies. You can see a very sharp move as well in recent weeks from a high of just around 25,400 to where we are right now, which is a drop of 8.7%. Will these moves continue? I guess traders have got to focus on the developments out of the Middle East and oil prices as they continue to weigh on equity markets. Let's now take a look at currency markets. Well, the classic oil trade for us FX traders has always been CAD yen. And CAD yen on the dailies here has not disappointed. Oil prices have been surging higher, and so has the CAD yen. If all else is equal and oil price is the only factor influencing markets, then it should have a positive correlation with the CAD yen exchange rate. We can see here in recent weeks, the CAD yen has shot higher. Why is that? Canada is a large exporter of oil, whereas Japan is a large net importer of oil and gas and other energy means. CAD yen is building upside momentum. You can see here stochastics are well above the 80 level mark, and you can also see exponential moving averages at 20, EMA in yellow above and accelerating, diverging away from the 50 EMA. For those of you trading some of the high beta currencies such as the Aussie or the Kiwi against US dollar, let's take a look at the daily chart for the Aussie. Now the Aussie had all the conditions that were right for further upside for the start of 2026. We had higher inflation in Australia, well above the RBA band of 2 to 3%. We've also had a growing economy, pretty strong employment growth as well, pre this US-Iran crisis. And that saw the Aussie shoot up to 71.5. But in recent weeks, with the escalation in the Middle East, we have seen risk-off sentiment take hold, and we've seen equities globally come off, oil prices higher. So Aussie has understandably come off as well too. It has dropped back, not too far. It has cracked the 20-day EMA support. We're currently looking at the 50-day EMA as possible support. That lies around 69.40. So for those of you looking to take a short-term trade on the Aussie, from the short side, looking for further lower levels, possible targets, 69.40 is the first target in mind, and then horizontal support comes in around just below 69 cents. For traders who are looking to buy the dip in the Aussie, potential target remains around 71.40.50, where we see 4 or 5 tops in recent weeks. And finally, for traders, let's take a look at the gold chart on the dailies. Now, what has happened so far until today? Gold has been consolidating in a pretty tight range. Overall, it's in a very strong uptrend on the dailies. We did push above 5,400 last week. We've made a top of just above 5,600, but the dips have been contained above the 5,000 US an ounce mark. You can see here clearly, price has been hugging that 20-day exponential moving average support over the last few days, but momentum has waned, and you can see stochastics down below here are between the 20-80 levels. Where to from here? We have two competing forces: safe haven demand for gold, but also safe haven demand for US dollars. Which one of those competing forces will win out in the short to medium term? Well, right now it's risk off, bearish sentiment. Is that enough to see the US dollar gain against most currencies and commodities, or will markets go into the safety of gold and other metals? So they're the kind of questions you need to answer when trading gold in the short to medium term. If you are trading gold in the short, medium term, keep an eye out for support around the 5,000 mark. If we do crack that, we may see a dip down to the next support level around 4,890, which is a 50-day EMA. For those of you looking to buy dips, potential upside target, again, is that 5,400 level that we saw early last week. Economic data will likely take a backseat this week to Middle East tensions, oil prices. Expect some wild swings. Volatility is an opportunity for traders. So watch your leverage, stay disciplined. I wish you well with your trading, and I'll see you in the next video.